Hello investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. I hope you've been following along with us each and every week. This is yet another example of how well technical analysis works as a forecasting tool, particularly with the candle charts. This is a 1-year daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA. And as I do each and every week, I've left my lines on the chart from last week's report so you can see again the percentage of accuracy and how it works. We were 100% accurate in our forecast for this week, and my goal is to continue on with this great record of accuracy each and every week so you can again learn from this repetition in analyzing the stocks, but really helping yourself with a good risk management plan. These, again, are the lines that I drew from last Friday. Now, here is the 19th, which is when I put out the report. And remember, this price action had not occurred at that point because, again, this is Friday the 19th. And I drew this diagonal line saying that I believe the stock would go up, fill the gap, and I drew a target resistance line right here in that horizontal line. So perfect accuracy. The reason I drew this line moving up and saying that the upward trend would take over is because this gap had filled, and after gaps filled, there's an 80% chance that the market or that stock price would reverse, and that's exactly what's happened. Later on in this video, I'll give you a link as to where you can go learn more about gap trading. So now that we've reached our target price, what does this look like for next week? Well, we have to again look for resistance, we have to analyze volume, and we have to put those two together. This is a resistance high right here from March 1st, so I'm going to draw a horizontal line from that point. That is the most current resistance point, and you can see that on Friday, right here, the 26th, the Dow Jones Industrial Average, or the diamonds, closed with a doji. And this is a perfect doji. Dojis are usually found at pivot points. That's number one. Number two, we have a gap below the market right here, and we see all of this upward action happening on lower volume. So when the prices are going up with volume dropping, that tells us that the buyers are losing some of that momentum. So my forecast for Monday and Tuesday and the rest of the week is that we will most likely pull back to this point right here, the end of that line being my target price, and we'll have to see how that works out. But I think there's a high probability chance that the markets will pull back next week. Now, if you look at the spiders, that's ticker symbol SPY. This is the S&P 500 ETF. Again, I've left my lines on the chart for you so you can see how this worked out. And right here is the 19th again. So I drew this diagonal line upward saying that the S&P would again most likely fill that gap. So my gap fill target was right here, and I said that there could even be a chance that we go up to test this resistance area, and that's exactly what happened. Now, going into next week, let me point out a couple of things, one of which is a stale green light where we have 7 green candles in a row in this upward direction here. And if you look back in time, even for the past year, you're going to be hard pressed to find more than 7 green candles in a row before seeing that red candle show up. And in fact, I'm having a hard time finding even 6 green candles back here. So what does that mean for next week? We have another gap below the market in the S&P. On Friday, we had a very small bodied candle on lower volume, so that means that the sellers will most likely move in next week. Now, my price target for the S&P is going to be at the 20-period moving average. That's right around 239.33. So that diagonal line, again, is what my forecast is for next week. The end of the line is what my price target is. Okay, let's move on to a more broad-based index, which is the Russell 2000. Again, those lines left in place. I said that the Russell 2000 will most likely move back to resistance here. This was my price target for the forecast. On Thursday, the Russell 2000 came within pennies of that target and then closed right back onto my line. Incredible, isn't it? It's not voodoo magic and tea leaves. This is technical analysis at its finest. And each and every week I do my best to teach our audience how to read these technical signals. And it's not rocket science. It will take some time to learn, but it's something that you can definitely learn and apply to your investing and your trading. Now, again, now that we've hit the target, what does this mean for next week? Well, I'm going to erase all of these lines. I'm going to keep Thursday's high as the resistance point right here. That's our resistance where the high was reached on that day. And being that we closed back down below that 20-period moving average, which is that blue line, I think that the Russell 2000, again, like the S&P and the Dow, will most likely pull back. And there's other reasons why I have that decision that I've made, one of which is the VIX, and I'll get to that last. Now again, there's my forecast line. Keep that in place. We'll look at that next week so that you can compare and see what the results are. And I have a good feeling that we're going to hit our price targets right across the board. Okay, now let's look at the Qs. This is the NASDAQ market. This was another stock that came up to my price target right there. We filled the gap. That horizontal line is the gap fill target. Remember, when there's gaps open, there's an 80% chance that the gaps will fill. So now that the gap has filled and we see that the price has moved up, we are going to look into next week. And what does that forecast look like? Well, there's another minor little gap right here. On Thursday, the market's gapped up all around, and so that's going to act as a price magnet. I think that the NASDAQ could also pull back to the 20-period moving average. It's been going up nicely this week, just like forecast, but the volume is dropping, and that tells us that there's lack of motivation on the buy side, so we're expecting lower prices there. Remember what I said about the VIX. Volatility index is the best leading indicator you can find, and it's something that I recommend everyone keep on their watch list. Last week I staked my reputation on the fact that this gap would fill. It has filled once again. Now we came to the price target right there, said there could be a chance that we're going to bounce. We hit this support level, and I think that the VIX is going to bounce. So what I'm going to do is keep this line in place. I'm just going to move it over a couple of days, and I'm going to lower my support level right here. So let me get to that right now by clearing my lines right off the chart, and I'm going to draw a new horizontal line right here, which is support. By the way, this is record lows. These are record 30-year lows for the VIX. Whenever the VIX gets down this low, the markets tend to find topping patterns, and we tend to go lower, particularly in the S&P. So now that the VIX is on historic lows, I think there's a great chance that the VIX is going to move up. And I'm going to be a little bit more aggressive with the VIX here because I think that we are definitely overbought in the markets overall, and the VIX is inversely related to that. So if the VIX starts to go up, general markets are going to start to go down. Now, last Monday on the 22nd, we had an open house Q&A session for our members. I want to again thank Ron, I want to thank Sean, I want to thank Leslie, Jim, Dell, and Paul, each for contributing stock symbols for us to analyze. And those folks especially know how accurate this has been, because when I analyzed their stocks on Monday, I analyzed Potash, I analyzed Weight Watchers, United Artists, SLV. I looked at EGRX, TNK, MGM. All of those forecasts, as I went back to review the recording, all of those forecasts were 100% accurate in what I said with regard to price action. This is phenomenal. Our charting systems, our charting methods that we use using candle charts is the most accurate in the world. We're currently tracking the highest percentage of accuracy out of any analyst in the world. And again, my goal is to teach you how to do the same. So I hope you enjoyed this. If you like, go visit the Market Guys website. You can go right there, www.themarketguys.com. Click on the video tab right at the top, and it will bring you to a lot of the concepts I've just talked about, particularly gap trading. You want to learn about that right there. You definitely want to learn about the 1% rule and the rubber band effect. Those are three concepts I'm going to point out to you so that you can review those. Very short videos, anywhere between 6 and 8 minutes long. You can really look at those in your spare time and get a good lesson on technical analysis and trading strategies. So have a great long weekend here in the US. Happy Memorial Day. Folks up in Canada, have a good week, and I'll speak with you next time on the Weekly Market Report. So long.
This video segment is a small part of what the Market Guys offer through their educational products and services. If you are interested in any of our Trade Alert services, or you would like more information about our one-on-one mentoring program, simply contact us at info@themarketguys.com.